So on the whole, transactions have been down in New South Wales. But what I would mention is that the number of assets that have been brought to the market is limited, and most of them are in regional locations and probably secondary assets. So yes, we're probably down in New South Wales, but the actual opportunity hasn't been there for quality retail investments.
Thank you. Now, a final question to the panel. What everyone would like to know, what I'd like to know, where would you put your next $100 million and why? We'll start with Rob Sewell.
Well, I think if you're a prime investor, all those charts show that it's going to be hard to buy something, and it's going to be more expensive to buy that probably in a year's time. So if something's in front of you, I'd be grabbing it. I think, and guess what? We don't have any prime office assets for sale at the moment, so I can say that. Look, there's value out in the suburbs. We're actually seeing some of these investors moving outside of the city and looking into markets like North Sydney, Parramatta, Chatswood, where there are high-quality assets, A-grade quality, and those markets are not overbuilt. They're actually undersupplied. And they're not affected by what the finance sector is doing at the moment. So there's great value there. Buying in the Sydney CBD secondary assets with yields of 8 to 9%, in my career, I haven't seen those sort of yields being offered. So looking for assets which have got solid WALEs of 3 years with sticky tenants, that's good value at the moment.
So opportunities in non-core and secondary markets.
Yep.
There. Joshua Charles, where would you put your next 100 million?
Here it is here. I'd be reassessing my leasing risk. We've heard about inquiry in New South Wales and industrial property being at all-time highs, or certainly for the last decade. Vacancy rates are right down in parts of Sydney, as you saw from that graph, on built product at less than 0.5%. Incentives are right down. There is pressure on rental growth. So I'd be looking at what everybody else seems to be steering clear of, and that's the 2 to 3 year leased properties. So something with an approaching lease expiry, and those with educated information, I suppose, on the leasing risk of that property, who can buy that in the mid to high nines, will definitely see the upside over the next 12 to 18 months.
Thank you. And retail, Stephen Lerche.
We've got a lot of privates chasing the smaller end of the market, so probably up to about the 20 million mark. We've also got the REITs and the trust that are trying to buy into the regional and major regional assets. So there's a real dearth of interest in the sub-regionals, something between $30 to $80 million. The yields on those assets have floated out quite a long way. There's a good margin, positive yield gap there. So I'd be looking at the sub-regional centres, prime assets within metropolitan Sydney, and even some of the secondary assets in regional locations.
Thanks. Now, I won't ask exactly the same question to David Milton, but I'll ask on the residential side, what are the main shifts you've seen in the market, and I guess what are the main opportunities and developments going forward?
Probably in the shifts that occurred in the last 2-3 years, is the first one is the opportunity to achieve volume pre-sales. We're in a market where there's very little supply and there's really strong underlying demand, and we found that it's been possible to be pre-selling up to 100% of projects. In actual fact, the projects we've taken to market over the last 18 months, we've achieved off plan an average of about 85% pre-sales prior to construction commencing. So it's been a market that's allowed with that sort of pre-sale really de-risking projects. The other big change is we've sold a much higher percentage of apartments off plan to owner-occupiers than we've ever sold before. Owner-occupiers account for about 50% of our buyers at the moment, where typically pre-construction they've sort of been 15 to 20% of the market. And again, that really reflects the shortage of supply in the market. And we've got a lot more buyers that are moving from an apartment and upgrading to a new apartment, whereas previously they would have bought and moved from an apartment to a house or a terrace, or changed in their property type. That hasn't been the trend. And we expect that trend will continue. So the residential market we see in Sydney for the next sort of 2, 3, 4 years, whilst there is such shortage of supply, a very strong market to be developing in.
Thank you. So I guess in summary, we've heard a lot today about we've heard about the demand for prime assets being strong. We expect that will translate to potentially secondary and non-core assets. We've heard a bit about global risk premiums and how they're important for valuations of property currently. Current levels really offer an opportunity to leverage yourself to an improvement in global sentiment. Importantly, we've heard a lot about what Alistair described as the internet furphy, and really just to downplay the impact that that's having on the significant rump of the property markets out there. On that note, I'd like to thank the panel, and thank you for listening. Thank you for your contributions.
And now, please welcome back to the stage Pacific President and CEO, Tom Southern.
All right, well, thank you very much for attending this morning on this beautiful English day. It's great to see so many important clients here. I do want you to know that we do appreciate and understand that without you, we don't have a business. And I think that's very important for us to keep at the forefront of our mind. It's been a very difficult couple of years, I think, for all of us. And I think it will continue to be challenging. There are a few people that I definitely want to thank for this morning. Stephen McNabb, I think, is really going to bring a new economic edge to our understanding of property and our ability to advise you and assist you in making good decisions. Very grateful for Nick to have made the trip. Dan here is obviously very committed to long-haul travel, and I think he's one of the best presenters that I've seen, certainly in the property arena. The panellists did a great job, and I'm very proud that they are in a position to give their views on the market without overly embellishing their comments. That's obviously been a trait of the past, I hope, in terms of our genre of service providers. What we're trying to do is to give you genuine, clear advice on what's going on in the market. I'd also like to recognise the colleagues that are down here from Asia for an Asia-Pacific board meeting. We've got representatives in the CEOs from Japan, India, Hong Kong, Singapore, as well as Rob Blaine, who's the CEO of the whole region. Now, unfortunately, Brett White has got stuck somewhere between immigration and the Western. And it's a shame because I do want to acknowledge him very specifically. Brett's been the CEO globally for 7 years. He's given a magnificent 30 years of service to the company. And to be honest, without his leadership and strong support here, I don't think we would have achieved the growth that we've been able to, nor the development of the business. Since 1998, when CBRE or CB took over Richard Ellis, we've achieved over 15% compound growth up until about 2008. Obviously, it's been slightly more difficult since then. So there are a lot of people here. I hope you get a chance to meet some of our Asian senior leaders. I think that from the perspective of going forward from here into the next couple of years, we were hoping that we'd perhaps be on a slightly more solid path and that things would be clearer. It's not going to be that way, I don't think. And I think for our business, we're hoping that we can work with you and try and navigate through what are going to be some still challenging times. So thank you very much, and we look forward to working with you during the rest of 2012.